Today we're going to be talking about putting together your very first stock portfolio, some of the key considerations that you need to make, and some tips and tricks in order to determine what type of stock portfolio suits you best. Let's take a look. How's it going, guys? Ryan here and welcome back to another stock investing video. And as I mentioned, today we are talking about how you can put together your very own stock portfolio, but more importantly, some tips and tricks that you can use in order to determine what type of stock portfolio best suits your needs and your driving factors. So we're going to be talking about things such as what is your overall strategy, some of the different risks and your risk appetite overall, and then as well some tips and tricks that you should also consider when formulating that portfolio itself. So without further ado, let's jump straight into it. First and foremost, before you start choosing what stocks you actually want to buy, you need to understand what your goals are as an investor and what your overall strategy is. So there are, I suppose, a few key strategies that you should consider using. The first is a growth strategy. That is purchasing stocks which grow and appreciate in value over time. The second is a dividend strategy, where you purchase stocks which provide regular dividends as a form of income over a period of time. Then the third consideration is trading. Now, trading is obviously a lot more high risk, and it involves buying and selling stocks in brief periods of time where you then make a profit based on the growth that has occurred due to various different catalysts. Now, of course, there is also a fourth option, and probably what most people will actually do eventually, and that is mixed, using a bunch of these different strategies when formulating your portfolio. So for instance, you may have some growth stocks and you may also have some dividend stocks in your portfolio, getting the best of both worlds. But the key thing is to understand what type of strategy you want to go for and what overall you're actually trying to achieve. Are you trying to achieve quick returns in a short period of time, or are you looking for consistent and stable growth over a number of years? That is very, very important when working out what stocks to buy. The second consideration is how involved you want to be in the stock portfolio management. So you've really got two options. The first of which is the self-managed approach. This is where you buy and sell your own stocks. You're making all the decisions on your own and you are wholly responsible for what you are investing in and what you're not investing in, and when you do decide to make changes to the portfolio itself. This is traditionally what most people see as stock investing. Now, there is also the managed approach, which means that you basically take a step back and let someone else do it for you. There's two ways to do this. The first of which is through managed funds, which is using the likes of a broker who will suggest, pick and choose different stocks for you. You do get some decision making in that, but they will be there recommending stock picks and assisting you, and you pay them basically a fee in order to do so. The other alternative is something like an ETF or an exchange traded funds. These are basically treated in a similar way to stocks, but what you're doing is you're putting in money into an ETF, which is basically comprised of a different subset of stocks. So example, you might have a lithium ETF, which is consisting of 20 of the top lithium stocks, or you may have a tech ETF, or you might have an ETF which follows the ASX 200 and consists of all the ASX 200 stocks that are currently listed. These are then managed by other entities. So you can use companies such as Vanguard in order to do this. And what happens is they will move and, I suppose, buy and sell different stocks, adjust and move around the portfolio over time to meet basically the requirements of whatever that portfolio is. So for example, with the ASX 200 style one, what you'd see is every time the ASX 200 is readjusted, all of those stocks which enter in the ASX 200 would be bought up into that ETF, and then those which have dropped out of the ASX 200 will be sold from that ETF. And you don't have to do anything. Basically, you're buying the ETF as if it was a stock itself, and then everything else is managed for you, and hopefully you will start to see the benefits and the returns from that ETF whilst having to basically do nothing at all. Now, this really brings us to our third consideration, which is what is your overall risk appetite? Do you have a high risk threshold, or do you want to play it safe and have a lower risk threshold? If you're choosing the route of going down ETFs or managed funds, typically what you'll see that these are a lot lower risk as they tend to follow overall trends or overall industries, or overall, I suppose, things such as the ASX 200, which are known to be stable and over long periods of time do see returns for investors. But of course, with low risk, you do potentially get significantly lower returns as well. The alternative is high risk, so taking the approach of trading, for example, buying in and getting out really quickly, whether that be in days, weeks, or even just a few months. Trading is significantly riskier as typically you'll be targeting stocks which aren't those blue chip style stocks. You'll be looking at those low micro cap stocks, getting in, getting out very quickly, or even possibly trading blue chips off the back of various announcements, earnings reports, that sort of thing. But it is a lot more risk involved because you're not allowing the market to play out overall. You're just trying to get in, get out as quickly as possible with a nice little bit of change as well, hopefully for you. So taking your risk appetite into consideration is very, very important because that ultimately will really dictate what type of stocks you invest in and what type of strategy you actually do go for overall. So if I was to go back to the start of my investing journey, how would I be putting together my very first stock portfolio, knowing what I know now after many years of investing in the stock market? Well, first and foremost, I would be adjusting my risk appetite so that I'm not going all in on one stock. I'd be diversifying my portfolio and making sure that I have a nice risk split. And my split would be something in the region of 80-20 or 70-30 in the scheme of 70 or 80% low risk stocks, which will consistently give me returns, and the other 20% of my capital going towards those high risk punts, I suppose you can call it, a bit more of a gamble, a bit more of a high risk in and out type scenarios where I am trying to make obviously a lot higher returns, but also with the high possibility that of course I could lose that money as well. That is sort of the way I would put things together. Now, would I go down the route of ETFs? Absolutely. I would combine ETFs along with different growth and blue chip dividend stocks in that 80% portfolio. Then the 20%, I wouldn't necessarily be trading, but I'd be looking for those higher risk investments that are those, mining exploration companies with the potential for explosive growth in the future. This would be a fantastic way to, I suppose, start to put things together. That wraps up today's video, guys. Let me know your thoughts down in the comment section below and tell me how you put together your very own stock portfolio and some of the other considerations that you take into account. If you did enjoy today's video, make sure you do leave a thumbs up, and if you want to see more of this sort of content, hit subscribe and turn on those bell notifications. I'll leave it there for today, guys. I hope you have an awesome day. I'll see you next time. Cheers.